Welcome to This Explainer. Today, we're unpacking a recent viral documentary that traces the incredible rise of a company you've almost certainly heard of, BlackRock. We're going to neutrally break down how a single Wall Street trader's idea evolved into an absolute global powerhouse. Let's dive right in.
So, we have to start with this really intriguing question posed by the source material. How exactly did one company go from being a Wall Street outcast to, well, effectively owning the global operating system of finance? It all begins with founder Larry Fink and his wildly ambitious journey. You know, Fink didn't actually start out with his eyes glued to Wall Street. He was originally a political science major at UCLA, dreaming of political power. But after taking just a few real estate classes, his ambitions completely shifted toward the financial capital of the world.
The source brilliantly uses this financial casserole analogy, and it's perfect for explaining mortgage-backed securities. When Fink arrived at the investment bank First Boston back in the late 1970s, he helped pioneer this highly complex product. Basically, you take a whole bunch of everyday home loans, bake them together into one financial product, and then slice that up to sell to investors. It was totally designed to diversify risk, and honestly, it made Fink an absolute superstar who was generating millions upon millions for his firm.
But as you might guess, that rapid rise hit a massive brick wall when a huge gamble on interest rates went terribly wrong. See, he was absolutely certain rates would rise, so he bought financial insurance, a hedge, just in case they didn't. Well, rates plunged instead. And that brings up the ultimate question of risk management. What actually happens if your safety net has a giant hole in it? One single numerical miscalculation on that hedge cost his firm $100 million. Let that sink in. In an instant, Fink went from being the star candidate for CEO to a total outcast without a job. It was a devastating blow for sure, but it taught him a very hard lesson that would eventually change global finance forever.
Section 1. The Aladdin Advantage. Mastering Risk.
To master this exact kind of risk, Fink launched BlackRock in 1988. He teamed up with some elite traders and managed to secure $5 million in backing from Blackstone's Stephen Schwarzman. And they immediately flipped the script on Wall Street. While traditional firms back then kept risk oversight and day-to-day investing in entirely separate silos, BlackRock embedded rigorous, state-of-the-art risk analysis directly into every single investment decision from day one.
Central to this whole strategy was a computerized risk simulation system they built, and they called it Aladdin. The documentary actually likens Aladdin to the Windows operating system of global finance. It lets them instantly simulate endless what-if scenarios for the markets. Today, this software is so ubiquitous that it tracks a staggering $21 trillion in assets. It's even used by their fiercest competitors.
And you can see how this paid off. Look at this timeline, founded in '88. Because of Aladdin's incredible risk modeling, they survived the infamous 1994 bond market massacre with minimal damage. They split from their initial backers, went public in 1999, and just kept growing. The message to the market became exceptionally clear. When risk gets complicated, you call BlackRock.
Section 2. Profiting from the crisis. Flash forward to 2008. While major banks were collapsing under the weight of the very mortgage-backed securities Fink had helped invent decades earlier, BlackRock emerged largely unscathed. Why? Because of their ultra-conservative risk management. Then opportunity knocked. Barclays desperately needed cash after making an acquisition that the source calls the financial equivalent of nuclear waste. That desperation allowed BlackRock to swoop in and buy Barclays' crown jewel, the ETF provider iShares, for $13.5 billion. Just like that, they transformed into the world's largest asset manager.
But here's the wild part. They weren't just buying assets. They were managing the crisis itself. The U.S. government was so desperate for help that Treasury officials reportedly called Fink 21 times in a single day to draft a playbook for rescuing the economy. They completely relied on BlackRock to restructure crumbling portfolios, value highly toxic assets, bail out collapsing banks, and manage massive bond buying programs.
Section 3. The political revolving door.
Now, after the crash, regulators introduced the too big to fail label to really clamp down on Wall Street risk. So how exactly did the world's largest asset manager dodge that specific designation? Well, the documentary argues they use a massive revolving door of personnel. By 2020, over 100 individuals had moved back and forth between BlackRock and top global governments. We're talking central bankers getting hired by BlackRock and executives getting placed in public office, like former BlackRock executive Friedrich Merz becoming Chancellor of Germany. The explainer notes this level of access helps them navigate and shape regulations while maintaining a highly advantageous passive investor status.
Section 4. The ESG experiment.
So, in the late 2010s, BlackRock was facing intense protests over their investments in fossil fuels. In response, Fink pivoted the company to heavily champion environmental, social, and governance, or ESG, principles. They aimed to force green corporate behaviors. But critics, both inside and out, were super skeptical. Whistleblower Tariq Fancy, a former BlackRock executive, claimed it was largely just marketing spin. As the source highlights, it was essentially the product equivalent of taking what you already had, painting it green, and putting a higher price tag on it to extract higher management fees without delivering real environmental impact.
And man, the political backlash was fierce. States like Florida pulled $2 billion in pension funds in protest, accusing the firm of pushing ideology over returns. In response to all this pressure, BlackRock executed a very quiet but profound retreat. Look at these numbers. Their support for ESG shareholder proposals plummeted from 50% in 2020 all the way down to just 4% in 2024.
Which brings us to our final section, the infrastructure endgame. With ESG kind of fading out and the ETF market reaching a saturation point, the explainer outlines BlackRock's massive new pivot. They are turning toward the physical, tangible lifelines we rely on every single day. By 2040, the world is going to need an estimated $68 trillion in infrastructure investment. That is a truly staggering demand, and BlackRock is rapidly positioning itself to be the one meeting it.
To actually capture this market, BlackRock recently went out and purchased an infrastructure firm for $12.5 billion. And their targets are absolutely essential things: regional water and sanitation systems, international airports, a massive $23 billion proposed deal for Panama Canal ports, and even post-war reconstruction power grids. Essentially, they are targeting regional monopolies where consumers like you and me simply have no alternative but to pay, which delivers incredibly stable, long-term returns for their funds.
The source material heavily critiques this approach, calling it a catalytic capital strategy. The argument here is that everyday taxpayers and public institutions are effectively being strong-armed into guaranteeing the capital and shouldering the heavy risk of this crumbling infrastructure. Meanwhile, private corporations reap the reward, extracting high returns and long-term fees.
The documentary also raises some highly controversial questions about BlackRock's involvement in places like Ukraine. Critics point out a rather troubling cycle. BlackRock holds passive stakes in major defense contractors. When global conflicts happen, infrastructure gets damaged. Then, the firm turns right around and secures extremely lucrative contracts to rebuild those very same war-torn regions. Now, BlackRock naturally counters that they simply track the broader market, right? They don't create these conflicts. But the explainer really illustrates BlackRock as an everything store for investors. Whether the world is leaning toward peace or sinking into conflict, their software, their algorithms, and their financial networks are positioned to profit. They respond to one thing and one thing only: the flow of money.
So we want to leave you with this final provocative thought right from the source material. As one private firm moves from managing digital assets to literally buying up the physical lifelines of modern civilization, who holds the ultimate power? Is it the governments we elect, or is it the software managing the world's money? It's a lot to think about. Thanks for joining me for this explainer, and definitely keep questioning the world around you.